Welcome back to another episode of the Success Times Happiness podcast. I'm your host, Richard Thompson. Today, I'm joined once again by financial expert Chris Harris, stockbroker, business owner, ABC radio commentator, and one of the sharpest economic minds on the Sunshine Coast. Today, we unpack the aftermath of the 2026 federal budget and what these major policy changes could mean for everyday Australians. From property investing, negative gearing to inflation, interest rates, and discretionary trusts, and the future of the economy as a whole. This conversation dives deep into real-world impacts behind the headlines. If you're wondering what this budget actually means for your finances, your investments, or your future, this conversation is for you. All right, let's get into it. Chris Harris, welcome to the show again.
Oh, thank you, Richard. Thank you. First time to do double header, back to back.
No, you're not the first guest to be on here twice.
Okay.
But as we've always discussed since you were last here in the election last year, as we found out,
that's true.
there was a well-received episode, and the people want what the people want, and it's C. Harris. We want budget. The budget has hit last night as we are recording.
Yes,
and we're getting this a special release because we call this a uni edit in house where Codes gets our interview, and within a few hours turns it around, does his magic, so the people will receive this in a couple of hours' time, and we are less than 24 hours aftermath of the 2026 federal election. And you are our financial expert, as always.
Oh, thank you.
You're welcome. And so we want to unpack what we should be feeling, what we should read. There's a lot of things in the press today, depending on which press you have subscribed to.
Yeah, that's right.
You'll get the vibe. But I guess from the outset, Chris, let's clear out the political bias.
Yeah. No, I think it's a very good idea. And when you and I we caught up, I think maybe about a month ago, and I sort of said, Richard, if you get space, it would probably be worth doing a budget show. And so thank you very much for allowing that. I said at that time that I think one of the keys to this podcast will be to put the cards on the table. And so straight up, I have no affiliations. I'm not a member of a political party. I don't even hand out pamphlets on voting days. I will admit that if there is a sausage sizzle, I don't particularly care who's on the barbecue. I will have a sausage,
whether it's red sauce or blue sauce.
Don't care. I will have tomato sauce with it. Probably some onions if they have it. Also, to give you the listener just a bit of a feel for my tolerances for, let's call it the political sort of beast and the fighting and the like. I sort of see let's call it this political debate, this cut and thrust. To me, it's a bit like watching maths. It's hard work. It is.
Hang on. Interject there, because I hear from your on phone calls with yourself and your daughter in the car that you are the one leading the maths charge at home. You're rerunning, watching, rewatching, recording.
No, there's never a recording. And to be straight up, I start to watch some episodes, and then as soon as the fighting gets too much or the bickering, I just have to turn it off. And I'm exactly the same with all the political speak. As soon as a politician describes what someone else is doing or what this is happening or blah, 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 I find myself turning it off. I find that reading the news and looking at it through a business lens, I get a lot more out of it. So the political beast of it is just of no interest to me.
So you are unbiased politically. You're just a red hot financial planner, stockbroker, businessman, your own company, your own business, family man, and Sunshine Coast expert of all things, and you're on the radio on the ABC, albeit no bias. Every morning, giving the financial updates from the markets the night before.
Yes.
So you're sitting there in the recliner, not you having pre-recorded maths because the budget's on. What is your initial takeaway?
My initial takeaway was, okay, this was released and a lot of the data was out and the news was out. But it is interesting because it's not until you sort of sleep on it, you hear a few commentators, you start to read a bit more information and take in a bit more data. And the more I've thought about this, there is without doubt that this will be disruptive. This will have an impact. There will be a change in people's decision making without doubt. The resi property piece, which I think you'd call it a full-time sport for most Australians. You know, that we adore it, we love it. It's so important in our lives. Last night's budget definitely has an impact on that. And so it's when you start to unpack it and start to think, if I owned a property, who now becomes a buyer? If I am thinking of buying a property, what does my exit look like at some point? You then have to consider what trust or structure you'll use. There's changes in that regard as well. So this will be disruptive. This will be disruptive. And look, it'll be good to unpack it today. I think, as I said to you recently, the way I'd like to sort of go through this for the listener is to give everyone a bit of background. I think this is the important piece. So I look at the economy through two lenses, really. The first one's monetary policy, think RBA. You then have fiscal policy, think government. You start to get an understanding of each of those columns, and then we can start to dive into what the budget looks like. So let's have a look at the RBA. Michelle Bullock's the governor. I think she's a really good governor. She presents really well. She's very, very articulate, and she's able to break down, let's call it, difficult pieces of information in bite-sized pieces that you can understand. But let's be really clear. The RBA isn't a street fight with inflation. If you think that the target is between 2 and 3%, we haven't been back there since 2021. If you have a look at the latest data, our 6-monthly annualised inflation print is at 3.9%. That's actually pre the war. Our 12-month position is 3.4%. If you think about the decisions they made last year, they cut 3 times in 2025. All of those have now been reversed, and we are, in the month of May. Debt markets are pricing in another increase in August. I would think that looking at last night's budget, if things don't sort of slow down quickly, I think that's probably likely. If you think about it from a monetary point of view, they sort of see, I suppose, the inflationary pulse through 2 main drivers. One is government spending and the other is immigration. So when you start to also bring that together, you've got to remember that Michelle Bullock, for all the hard work that her and her team put in, they only really have one tool.
They have one lever.
One lever. And that is really simply interest rates. And sadly, it's pretty brutal. And if you think where interest rates are now on a mortgage, debt and the like, it is getting to the point of being restrictive, you would have to think. Her preference, I suppose, if you think back to when you were a kid, Richard, and your mum would say, okay, Richard, you do that again, I'm going to hit you with the wooden spoon. Michelle can jawbone the markets by saying, if things don't cool off, I will raise interest rates. But if behaviour doesn't improve, there is a smack. And so I would hope that we don't need, I'm hoping that we don't need to see another one, but I would say just pretty simply on data, it's going to be there. If I then look at how they possibly sort of move going forward, debt markets are probably suggesting that they stay higher for longer. So if they get to 4.6%, that's it. They'll be there for a while and they'll probably prefer not to go higher. If we then have a look at the next part of the puzzle, let's look at the fiscal position and let's try and blend that with bits of the budget, because the budget's pretty good. It gives you a huge amount of data. Again, there'll be a bit of numbers, but let's not get bored and bogged down at it. But if you want to understand how our economy looks, basically for 26, 27, we're looking to raise about $802 billion. So that's through taxing, and we're going to spend $833 billion. So you look at that, you've got a budget deficit of around $31 billion. Now, what's probably become a little bit too common and a little bit too relied upon is governments do all this off-budget spending, which I think is a bit annoying. But basically, there's another $33 billion of off-budget spending. And they're basically saying
Is that like with your spouse, you've got a separate account that no one knows about? Is that what we're talking about?
That's what it feels like, doesn't it?
That's just the tab account, honey. Don't worry about that.
That's right. That is off budget. The funny thing is, the number that doesn't lie in the end is actually your level of debt. So they can tell you every year, the budget's not too bad. We're only out of pocket a little bit. And then they go, but hold on, look over there. There's the NBN. And you're like, wow, that costs billions. Oh, you're like, look, there's my tab account. It doesn't have as much as I thought it did.
Yes, in fact, it's in the
that's
red.
right. Exactly right. So when you start to add that all together, the budget deficits are larger than what they sort of put forward.
So you're proposing that the 27 year, the actual deficit will be $64 billion.
Correct.
And do we have a position of what our net debt position is as a country right now?
Well, the net debt position's better. The net debt position is somewhere around $600 billion. If you look at our gross debt position, so you just start to say what's the total level of our debt, and we'll go through $1 trillion as at 30 June 2027. So that's money that has to be paid back at some point.
Can it be foreshadowed? Like, at what point would we envisage that to be paid back?
Well, that's a good question, isn't it? I mean, that's the hard part. What the way markets make governments behave is through bonds. And so if you have a look at, say, 10-year Treasury, we call them government bonds. So if you look at 10-year government bonds for Australia, just recently, for them to borrow money from offshore was costing us 5% per annum. The US is able to borrow at 4.3. Funnily enough, European countries are able to go lower again. What that tells you is in the end, when your interest expense becomes so great that then the focus becomes on actually paying down the debt. But at this point, we just keep sort of pushing it to the side, I suppose. If we then have a quick look at two elements then that are worth, I just think, considering. The first thing is, where do we get most of our tax revenue from? And it's personal income tax. And the last time we caught up, we were talking about PAYG and it being relied upon so heavily for making the books balance.
So we've got 41% of this 800 odd billion is made up of PAYG, personal income tax.
That's right.
Do we know what that is relative to comparable countries?
I know it's higher.
Okay.
I do know it's higher.
It's one of the highest.
Yeah, it is. Yeah. We rely heavily, if you have a think about the sort of breakdown of that. So the top 5% of taxpayers account for 32% of that, and the top 10% of taxpayers account for nearly 50% of it. Yeah. So it's a hell of a lean. It's a hell of a lean. So to anyone out there who's working hard, continue to work hard, please, because we need someone to help pay the bills. If I then look at the largest expense on the other side, and that's social security and welfare, that's about $308 billion or 37%. Quite interesting, isn't it? They sort of net each other off nearly. One of the observations here is the NDIS. So when I went into last night's budget, I was really interested to see what was going to happen around the NDIS, because it is very, very expensive. Does it do a lot of good? I'm sure it does, but it's very, very expensive. I think it looks after around 900,000 odd people, and so for that, it is it's basically expensive. We're thinking it will go from about 50 billion to 56 billion. One of the things which really sort of does irk me a little bit when it comes to the political speak, and then also the delivering of news to someone, is they'll say we're cutting the NDIS, and you think to yourself, really, this is going to be fantastic. I wonder what it's going to go from. Is it going to go from 50 to 45 to 40, something along those lines? But that's not actually true. What ends up happening is they'll say we're just going to cut it looking forward. So if it was increasing by a certain amount, we're not going to let it increase by that a certain amount. We're just going to keep it at rough numbers where it is at the moment, and they treat that then as savings. But that's like me going to the doctor and he says, "Chris, you got to lose 5 kilos," and I say, "Mm-hmm," and he says, "Well, it's important," and I say, "I think you're probably right." I said, "It's hard. It's a challenge, though, isn't it? Because I like steak and chips." Not just steak.
But you could say to the doctor, well, doc, I was planning on gaining 10 kilos this year.
Yes.
But if I don't gain 10 kilos, then I've already lost 5.
Correct.
So we've successfully achieved what you've set out to achieve.
Huzzah. There it is.
Without lifting a finger,
That's right.
Chris.
Now, what happens if I continue to eat the steak and the chips?
Right. You probably just gained 5 kilos, not the normal 10, and you've saved 5.
Correct. And there it is. And so that's the sort of stuff that I look at sometimes, and I think.
So is the proposed NDIS reform not, in fact, cutting the current spend? It's just cutting the growth of the spend.
Yeah, that's how I looked at it, because when I saw the numbers, it goes from 56 then to say 56, 57, 57, 58, right. 57, 59. So it is increasing, but nowhere near
what they were planning.
Correct. So look, how does this all look? Because we're going down each of these paths. Mm-hmm. So when we look at it, we go, okay, well, debt, when we say get to June 2029, will be about 35.8% of GDP. But for some perspective out there, people, before we panic, US is around 107, Europe's around 87. So they're up truly much higher than us.
This may sound a ridiculous question, and I have an accounting degree. I don't ever use it, nor should I. If the US is at 107 debt to GDP and Europe's at 87, who is funding the money? Where is the actual money coming from? If every country, every civilized nation is in debt, where is the actual real money coming from?
Well, this is the reason why Trump's going over to say hi to China. Could be part of the reason why we have a war in Iran. Indeed. But that's another episode for one of your one of your listeners. So if we look at that, we say, okay, debt's increasing, nowhere near, let's say, counterparts in the world. If we look at what's out there for immigration, 295,000 people, 245, 225. So that is actually lower than the last handful of years. So if we then try and start to bring this together, we've got a few assumptions that were sort of put forward. One, the Treasury saying we're going to get to inflation of 5%. That's a decent number. That's high. The RBA is saying 4.5%. Treasury saying we'll get back to 2.5% next year. The RBA is saying, well, we don't see it that way. Both the RBA and the Treasury see unemployment rising and real wages to grow according to Treasury, but the RBA sees that as a fall. So we do have our two sort of big think tanks a little bit.
Real wages to grow, inflation adjusted.
Yeah, but the RBA is saying that won't happen. They're saying we've got a contraction. So if I was to summarise where we are at the moment, I would say you and I, Richard, are walking through the wetlands.
Mm-hmm.
I've got those sort of fishing jodhpur pants on, but you don't. You've got shorts, joggers.
I was just going for a run.
You're going for a run. There's mozzies about.
We're in the wetlands.
Wetlands. It's better than a swamp.
True.
Yeah.
Yeah. I mean,
Yeah.
We're still moving.
We're moving. We're moving forward.
To dry land.
Dry land.
But it's not there yet.
Not there yet. We've got mozzies, but that's okay. No gators.
That's good.
That's for your American listeners if you've got a few, or crocodiles. And so that's where we are. So RBA saying foot on the brake. Treasury saying we look okay. Economic data, they both sort of agree with broadly, but there are differences. And so that then is where we get to in terms of last night's budget.
And so that, in terms of fiscal and monetary policy, they think that that's going to curb inflation and keep the GDP growing, if not marginally. Hey guys, just popping in quickly to say thank you so much for listening to the podcast. If you're enjoying this episode, it would mean a lot if you take a second to follow the show, leave a like or review, and share it with a friend. That support genuinely helps us grow and keep bringing you more great conversations every single week. All right, let's get back into it. So there hasn't been any, and certainly in the RBA's most recent release, out of the 88 pages, recession was not used once. And certainly last night there was no discussion about no growth in any quarter.
Yes.
So your view on that?
I'm not that confident. So I think the last time I was on the podcast with you, we looked at GDP per capita, and that was when you take gross domestic product, you divide it by the number of people in the country, you have a number. What's been happening there is where our GDP is growing, but the population's growing quicker. We are actually contracting. So we have been in a, let's call it per capita basis, not very healthy. At a headline level, it looks good, but that's because more people are coming in. And government spending's up. At this point, you'd say, the chance that doesn't look like a recession. However, it probably feels like a recession to people. And I think last night's budget, this is why I think it could be disruptive. If not handled well, I could see things slowing pretty quickly. I mean, the resi property changes are pretty substantial.
Where did the government get to with immigration?
Well, it looks as though it's dropping, but every year it's almost like our NDIS, our NDIS analogy. You know, I'll do this if you don't. They say the number, but we always seem to go over.
There's still there's still 500,000 people coming in.
Correct. And they'll say, look, the number's 295,000, but inevitably it's 450 or 500. It's just
given that immigration is such a key element.
It is
to the GDP, to the growth, to inflation. And realistically, unless they're refugees, that is a government policy.
Yes.
For whichever side of the aisle you want to sit on.
Yep.
And so they seemed to just be willing to, similar to the NDIS, as you said, just to say, we expect it.
Yes.
Without any proposed policy
that
is going to forcefully limit or reduce.
Yep. That's right. That's right. So it's a number to watch. So, but if we have a look at all the announcements last night, they now have to become law. I mean, that's the legislative piece. So you being a lawyer, you've probably got a better understanding of the process from here. But did you want to run us through how this now works?
Very simply, they will propose. There's been some announcements that are effectively set to take place as of last night, which is quite dramatic. But that is a retrospective date that once the bills are proposed to the House of Representatives, that will then be approved because Labor has the majority.
They do. Stonking. And
then stonking is the apt word. And then it goes to the Senate. They'll hear it a couple of times in the House of Reps, and the public will see it.
Yep.
And then it'll be sent upstairs. Usually the backdoor work because they need the Greens or the coalition for the approval. Coalition's come out this morning to say they will not.
Yeah.
Certainly the CGT stuff and the negative gearing stuff, they've said they're not agreeing to that. So they don't have the majority in the upper house in the Senate. And so the Senate, they'll need the Greens to agree to that. The Greens came on, I heard on the radio this morning that they said that it doesn't tax the hyper wealthy, but obviously goes to that level above. So I can't, without me being a political analysis, I can't imagine Greens are going to say no.
Yeah, I agree.
They're going to certainly try their best to add extras. So yeah, once the Senate approves it, it then gets a royal assent and passes legislation, and
it's game on.
It's law.
It is law.
That's the short and curlies of how a budget paper can become law.
There you go. So let's assume for the moment that it does pass, but there could be changes. So let's be clear on that. So let's have a look at the changes, though, that really did make impact. So we've got capital gains tax changes. They sort of, in my opinion, there's two elements there. There's the cost-based indexation.
All right, hold on.
Yeah.
Our audience, especially the Gators in America, they're not fully aware of what CGT is.
Yep.
So the government effectively says if you hold an asset,
yes,
whether it be a house, property, crypto, limited edition, maths, season 1,
signed T-shirt,
whatever that asset is, principally, the gain that you get when you sell, is up for potentially being taxed.
Correct.
There are some discounts, Chris.
There are.
And there were some very good discounts, Chris.
They were.
Before 1985, there was no CGT.
Tax. Correct.
And what continues is in terms of property, if you live in it, if it's your principal place of residence,
it's exempt.
There is no tax. So if you sold it for $1 million more, that is clean yours, not the government's.
Clean money, yep.
If you hold an asset for over a year, this is up until yesterday, if you hold an asset for over a year, so you're not short-term trading,
nope,
you get a 50% discount. And the tax, and how they deal with that obviously is they work out the gain.
Yep.
And then let's say there's a 50% discount on that because you've held it for a year. Then they halve that gain and add it to and assume that that's your income for the year.
Yep.
So that's not the 50% of that is not what you give to the government.
No.
It's attributed to your relevant marginal tax rate.
Correct. That's exactly right. That's a good summary. Well done. So, thank you.
No, that's okay. And just on that, I just thought we talked about how personal income tax is 41%.
Yes.
That would come into the CGT?
No.
Or is it classified as
no, it is. You're right. It is.
It's treated as your personal income tax.
Yeah.
And importantly, as you said, owning homes, owning houses, particularly residential in Australia, is a national sport.
It is a national sport.
And everyone presumably would hold it for more than a year.
Yep.
If it came time to sell,
you
get a 50% discount on the gain.
Yep.
But you also could negative gear it.
Yep.
So
that's the next policy.
That's the next policy.
Yeah, and they dovetail, and they dovetail.
They do
into
dovetail.
each other, which is so where you're heading to is perfect.
But the problem is, as the government saw, is that because of the CGT discount of 50%, because of the negative gearing piece, you could leverage and keep leveraging and not selling your assets, not selling these houses.
Yeah.
And you have these landlords that have 4, 5, 6, 10, 15 properties, which makes it very difficult for younger Australians to get into the market, increases house prices, and puts everyone into rent.
Exactly. And so the workarounds, because as you can imagine, we're innovative people. So the workarounds would be for younger people. They end up staying at home if they can, and they'll buy a rental property and they'll negatively gear that against their salary and wage. And that's generally been the steps that people will take. As of last night, that now becomes challenging. For the asset that they've currently got, yes, they can carry that forward. That's part of the rules that were put forward last night. You can negatively gear that. That's fine. But the issue will be is if that is not the ideal place where they want to live, but this was their way of getting into, let's call it that property piece, the person who they'll be selling that to, it has to be their principal place of residence, or they are an investor, but they will probably want a pretty decent return on the asset because they don't get the gearing or they don't get the losses to be able to negatively gear. So this is where I find that this could be actually quite disruptive. I think if there were people who were thinking of selling, I think after last night's budget, they're probably thinking to themselves, hold on, we need to sort of have a real close look here. Are we going to see a number of people look to release their properties, or do people now just hold? The question I suppose really it comes back to is the government must believe that this strategy of curbing the CGT discount and also curbing negative gearing there and allowing it on new builds, they're probably hoping that the supply side of things picks up.
None of this applies. None of these changes apply to new builds. So
Correct.
It's trying to funnel the property wealth in the country, private wealth, to new builds to account for the immigration that's coming in.
Exactly right. So this is young people just within Australia that are looking for a home. And yes, then to your point, there's immigration. There are rules around that sort of stop, non-residents from buying property. Those are fine. But what it really does, to your point, come back to is, will the changes that are happening increase the supply? And this is why I wanted to spend the start of the podcast looking at both the monetary and the fiscal side of things. Because the monetary side of things and the way Michelle Bullock sees the world is she's saying interest rates are going to be staying up for a while. So the cost of borrowing is going to stay up for a while. The other problem we then have is the cost to build is just so expensive. So unless builders can see themselves making a profit, and so they should, they take a hell of a risk. I don't know whether we're going to get the supply that the government thinks we will. Now, they can put money into sort of helping, property deals get over the line by, sort of helping towards sewerage and sort of other sort of infrastructure pieces. If this change that's being proposed doesn't result in a significant pickup in the supply of new housing, I don't think people are selling. I think people just continue to hold that asset. I think they'll say, well, I'm under the negative gearing regime.
Yep.
I'll hold the asset.
No incentive to sell.
I've got no incentive to sell. And the next thing then is the government's basically said, going forward on anything that you sell, there's going to be a minimum capital gains tax after the real gain. So they'll allow you to sort of take into consideration that CPI increase of 30%. And so it doesn't come back to your marginal tax rate. And it's not just on housing, it's on all assets. So the capital gains tax regime is changing in a pretty meaningful way. They're basically saying you will pay a minimum of 30% tax regardless of your marginal position, whereas at this point, if I give you an example, my son works part-time as a tennis coach, doesn't earn very much, but has saved enough money to go and start buying some shares to invest. His tax rate, let's say at most, would be 16%. Under this, if he made a gain, old school way, he would be out of pocket for the tax, 16% on the gain. Held the asset for less than 12 months. This is basically saying now, no, your minimum tax position is 30. So now he's got to pay another $1,400 in tax on the gain if he made $10,000.
Yeah.
So it's one of those things that you sort of look at and think, hold on. And as I said, when I first looked at this, I thought maybe this isn't going to be too bad. But when I start to look at it, I think, well, hold on, this is pretty disruptive. So this person who's, whether he's just trying to make his way, just trying to save up money for a deposit, all sorts of things, all of a sudden he's giving away 30% of everything he's making on a capital gain.
The intent there obviously is that they want to recoup the tax because these people who have negatively geared their houses throughout their life where they've had the most income and now they're coming back where their income's part-time and they're almost in retirement.
Yeah.
They want to be able to clip them for 30% and it's straight.
Well, that's right, but they're getting everyone.
100%. And
So there's no
what I
carve-out.
found that it is disruptive because the 1985 rule
Yes.
applied through all of these
It
discounts
has.
and everything. Now, as of 30th of June 2027,
Yep.
from then on,
Yep.
it's the new regime. Even if you held the property since the 1960s.
That's right. So you'll have to again go and get the asset revalued as at 30 June 2027, and that'll be your reset cost base. So it's substantial. As I
Time
said,
to be a valuer, by the way.
it's time to be everything. I mean, you must be laughing. When I thought last night, who is going to win out of this? I went, Richard, my accountant. I thought valuers.
I don't know.
You know, I just thought to myself,
Fin planners, mate. You just
Well,
help me, Chris. Help me.
Well, we do get some pickup because the idea of negative gearing, you get negative gear shares.
100%.
And you can negative gear commercial property, you just can't negative gear resi property. So as I said, I think in some respects this could be really quite disruptive.
Yeah, so talk to me about the negative gearing piece on other asset classes.
Well, I mean, it's interesting. I quite like commercial property as an asset class because I've always liked it from the perspective of generally when you're dealing with a seller, as a buyer, you calculate what you think the cost per value is, and so you have a reasonableness around whether it's what cost you should be paying per square meter, and then in addition to that, around the lease, you can then say, well, I'm looking for a yield of 5% or 5.5%. So you end up buying it using those two metrics. So the idea of negative gearing in commercial property generally doesn't happen. It has recent times because capitalisation rates have dropped so much. But resi, on the other hand, is nearly always negatively geared because by the time you buy something, you get let's call it a gross yield of, let's call it 3 or 4%, depending on where you're buying. You take off costs, you're down to 2.5%, 2.8%, but you're borrowing at 6%. The negative gearing piece is a lay down misere. Whereas, say with shares and commercial property, as an example, you can have these scenarios where you're positively geared. But we've got to look at the policy. The policy is all about making sure that there's housing available for young Australians. Like, that's what the policy is about. The only thing I'm asking is I don't know whether it actually achieves that. I don't know whether we're going to get a lot more supply, but we actually need a lot of supply because we've got people coming in, and we've got young people who may have the aspirations of owning a house.
Yeah, I guess to provide that supply, they have two avenues. One is they provide changes to CGT and to negatively gearing to force the landlords to sell, to flood the markets. And this is now no longer beneficial for me. And I'll put all my 16 houses back in the market so that the younger people can buy. Or you build them. They're the only two bits.
Yeah, it is the only two bits.
Your position is that the framework from last night isn't strong enough for column A.
Yeah, I don't
to
think
force
so.
the landlords to go, we need to sell.
Yeah, I don't think it will.
Because the grandfathering, effectively.
Well, the grandfathering. Yeah, exactly right. So they've basically said, we'll allow you to keep negatively gearing. Look, there's going to be some complexities around the capital gains tax calculation. But look, that's for an accountant to work out, and the person still gets a 50% discount on the value of the asset up to 30 June 2027, et cetera, et cetera. So there's all these things that don't force them out. That's okay. But then to exactly what you've said, and that is, do we then get enough supply coming in? I just don't know. It's
challenging because the cost of cash and the cost of building are both quite high.
Yeah. And so even if you build new, are they going to be cheap new? No, they're just going to be expensive new. So you've got expensive new. So now, so again, you've got the investor who may buy expensive new and gets the deduction.
And we're in exactly the same place.
And we're in the exact same place.
Yeah.
So I don't know.
Creates the supply for the renters.
Yes.
But that's the same place we're in right now.
That's right. So then the other change, which I think is a real doozy, and it snuck up on me, and I thought, wow, this is. I don't think people actually really looked at this until they looked at it, and I'm one of them. But this minimum tax on discretionary trusts is unbelievable. Like, that just 30%, you're copping it flat.
As the trustee.
I mean, it is amazing. That is, when I read that, I thought, that can't be right. I thought 30%. So I'll take you back a step. Bill Shorten a few years ago proposed a change to, 1, negative gearing, and 2, also the refund of imputation credits. So imputation credits are a company makes a profit they pay tax. For paying that tax, an imputation credit attaches to the dividend that they pay. Now,
so if the company makes $1,
yep,
they pay, let's say, 30 cents
yep,
to the government.
Yep.
Then 70 cents
yep,
is distributed to you as the owner.
Yep.
And do you have to pay full tax on that 70%? On that 70 cents?
Depends, doesn't it? It depends. So what happens is the 70 cents comes to you. So let's say it's a self-managed super fund and you're in pension mode. The tax rate's 0. So the recipient gets the 70 cents, but they then also get the 30% or the 30 cents that attaches to that 70 cents. So they're effectively getting the $1. The tax return gets done for the self-managed super fund. They go, well, it looks as though you've actually paid here 30 cents tax. You shouldn't have, and we'll give that back to you. So they end up getting a refund. And Bill and Treasury looked and went, wow, that is way too generous. Like, that is way too generous. You can't be getting that refund back. And so it was on the back of that he took that policy to the election and lost.
Didn't do well.
No. But this way, this is actually quite sneaky, really, because what they're effectively doing is the same thing. They're basically saying whatever comes into the trust, we'll tax at 30%. Whatever you pay out to the beneficiaries, if the tax, I think this is how it's going to work, if the tax that they pay is less than 30%, they're not going to get a refund of the difference. That just gets lost. And if it's greater than 30 cents, then there'll be a make-up.
Of course there will be.
Yeah. Now, the next thing is they say, well, if you distribute that not to a human, but let's say to a bucket company, which is quite a common strategy, it's a belief that that actual credit will not flow to the bucket company. So then there's the loss. So the whole idea, like, this is a big change. Now, what is it necessary? Yeah, maybe. I don't know. I don't know. I don't know. I don't have an opinion on it and whether it needed to change or not. I haven't seen enough of the numbers, I suppose. But it is enormous. Like, it is enormous. And so you look at it and you think, okay, these rule changes for me are so substantial and so significant that they probably did warrant being asked at an election as opposed to through a budget.
Whoa, says Chris Harris.
Well,
a little bit political, friend.
No, because I look at it now and I think, well, the changes are so substantial and affect so many people.
I thought about this last night, trying to be as apolitical as I possibly can. Whether you like it or not, or whether you think it's relevant or necessary or otherwise, to your point, a party is elected and given the mandate to govern on the back of the policy that it gives to the people. Yeah. And the question that needs to be considered, and probably is always considered at every single broken promise parliament, government, politician of all time, is to say, well, there's no ramifications other than in a couple of years being tossed if that's what the people, that's democracy.
Exactly.
But there's no legal ramification.
No.
To say, well, we promised you.
Yes.
Under the ACL, a corporation couldn't do that. It couldn't deceptive and mislead.
No.
On a commercial footing.
Agreed.
To say, this is what my product does. Yeah. And then in 12 months' time, the product doesn't do that. It does the opposite.
Yes.
You'd be sued.
Okay, yeah, that's right. And so what is interesting, because they have such a strong mandate, when we spoke about this, I mean, they will get through the House of Reps easily. There might be some toing and froing, and really, I think the Greens broadly like the strategy and what's been put forward. So this could go through really unchanged, which is quite amazing, really. As I said, I just don't know whether it's going to do what they want it to do. Yes, it will raise taxes. Things will get more complex. Will it supply more housing? I'm not sold on yet.
The question that the ABC asked last night, which I thought was relevant, except that she was proposing what you're saying.
Yeah.
You didn't bring this to the election.
Yeah.
But you're doing it now. The election was only 12 months ago. And what? 12 months ago.
Yeah, it was about that. It goes quick.
What were the circumstances? How have the circumstances become so materially different that you didn't bring this to the election? And because you can imagine governments have to be nimble, have to change. COVID comes, we didn't throw out the COVID plan in 2018 because it wasn't there. And what has changed?
What was the answer?
It's a political answer.
I hate those political answers. They're the ones that irk me. That's the reason why.
Put on maths.
Yeah, it is. But until they start fighting you, turn it off.
Oh, God.
So look, all said and done, the next thing, I suppose, two pieces. One, which is sort of like a bit of an odd benefit for everyone that's working, is the $250. I'd prefer they just change the brackets, the tax brackets. I think that's just a better solution. And there's an instant write-off for $1,000 for people that can't get paperwork together to make up $1,000 worth of deduction. So I think James Harris is getting $1,000 worth of deduction somehow. And Emma,
that offsets his wins on the stock market.
Well, there it is. That's the only thing you can do. All in all, if I was to break this down for listeners in terms of how do we currently see the world? Where the interest rates are where they are, you'd have to think cash and term deposits look okay. Like term deposits are now for 6 months paying 5.5%. Bonds are looking interesting. Subordinated notes are looking interesting. We did a capital raise the other day with NextDC, and that was yielding nearly high sevens. So cash and fixed interest looks quite interesting. Resi property, I think, just looks really messy for the moment because you actually do not know what happens next.
Unless it's PPR.
Yeah, PPR will always overrule. In terms of equities, well, in a global sense, all equities aren't cheap from a price earnings point of view. The earnings out of the US, though, have been really strong, particularly with the IT companies and the big tech. So US market's been basically making all-time highs there.
Where do we get to on that? How do you calibrate the cost of the cash?
Yep.
The cost of real estate.
Yep.
The price of gold,
yep.
which has come off a bit, but
it
was high. Yep. And the markets are otherwise overvalued.
Yep.
Where in a 2-minute synopsis, it sounds like everything's expensive.
Well, I just think you keep your hands in your pockets for 5 minutes.
I don't want to do that though, Chris.
I know, but we're all the same.
I either want the wooden spoon or
the trophy. But that's and this is why I think it could have more of an impact than what we think. Because I actually, when you start to really consider what am I stepping into, the uncertainty has picked up. And with the uncertainty picking up, whether that be around the war, whether that be around our policy, whether that be, and that's taxation and the like, you are almost better served just waiting. Now, when you wait, that just has a natural outcome of slowing things down anyway. And so that's the reason why when you sort of wrap it up in a nice little bow, you may as well wait, or you choose things that may do particularly well in a terrible environment like a war. You know, whether you buy oil or oil companies or something like that. But I don't want to talk about that sort of stuff. Yeah. All I want to say is, at this point, when you look at cost of capital, availability of capital, and the changes that are being made, you just got to participate with care, I reckon.
At least you get the $250.
That's true. I mean, what a high. Well, that's it. I mean, that's the steak and chip lunch.
Hopefully, Michelle's okay with that. Do you reckon she'll be fine with $250?
Well, I think if I listen to Michelle, she was throwing some warnings out there. She wanted these boys to tread very carefully, very carefully. Mm. And what could end up happening, funnily enough, is with what's been announced, we may find that things slow down economically anyway, and that does some of her work.
Correct.
So we could end up finding here, as I said, depending on how quickly this all moves, maybe you get a one rate rise in August and that's done. It's one of those wait and sees. It's a really interesting economic and sort of global environment at the moment. It's been pretty interesting.
Thanks for sharing.
Pleasure.
I don't want it to be another year before you come in. The emails that come into my inbox to say, get Chris Harris back.
You are full of it.
It is.
Yeah.
I'll get a reprieve now.
Yeah.
But they'll come up again. Given you are a guest, I know whether I asked you last time.
Yeah.
Quick fire questions.
Oh, yeah.
What does success mean to you, C. Harris?
I think my answer last time was to be able to make decisions and do things that I really want to do, and I still sort of put that down. Like I like working, so I want to work, but I also like playing golf on a Saturday, so I want to play golf on a Saturday. If I want to go and watch the girls ride, I want to go and watch the girls ride the horses, that sort of stuff. That's what it is for me.
Happiness?
I think last time I said sitting on the mower and riding around the property. And you know what? I did that on Saturday and I didn't mind it. Yeah, it was pretty good. It was pretty good.
Seeing the birds fly through of an evening down.
Well, it is.
Through
Yeah,
the
it's beautiful.
valley.
I like the galahs. They're good fun. So look, it's real simple stuff for me. I really love catching up with friends, people. Yeah, that's sort of basic stuff's good.
What's your morning routine look like normally?
Oh, good question. Well, what I'm trying to do now is I'm having listened to the doctor. I haven't been to the doctor, but I try to get up now, go to the gym, do a quick workout, and then get home, prepare for the radio for the ABC, deliver that, whether that's at home or up at the office, and get into it.
Doctor does know that you would have done 3 sessions, but it's to lose that 5 kilos, but you're not going to lose the 5 kilos.
I'm just saying I won't put more on.
One piece of advice, maybe from the budget, maybe you've already said it, but one piece of advice, let's give it topical for people, for the listeners to take away from about last night.
I'd go back to actually what I said before, and that is I would just keep my hands in my pockets for 5 minutes. I just really would keep a watch on this. There's lots of moving parts. Don't ever forget that politicians at their very heart are politicians. So that there's nothing to say that they don't come in hard as they did last night, listen to these sorts of podcasts and retreat in some way. Don't be surprised. I mean, at the end of the day, what does a politician want? They want to get voted back in.
Yep.
That's all they care about, to be honest with you. And so they hear enough of this sort of stuff, I think you'll find they'll step back. So I don't see there any prizes at the moment for being first mover. And
a guest that someone that you know who should come on the show?
Yeah, good question. I think I answered this last time.
Yui, you're...
Yeah. I'll tell you a guy who is quite interesting, actually, is and he's a mate of mine, is Hugo Schroeder. Have you ever met Hugo?
No.
So he was the CEO of Yui.
Yeah, I think you said that last time, though. Go to someone else? I'll get Hugo on.
Yeah.
Give me another one.
I don't know whether I've got that many interesting mates. I'll tell you who there probably would be quite interesting. There's a couple of guys I play golf with of a Saturday morning. They sort of range from, I'm the youngest, funnily enough,
they
at
range
50.
from 80 to 95.
86 down to 50, and I'm still not the best golfer. One of those boys, I reckon, would be pretty interesting.
All right. We'll get one of your golfing cronies.
Apologies, people, for the next podcast.
Chris Harris from Audmanet at Noosa. You're a legend.
Thank you, Richard.
I'm happy to give the people what the people want, so thank you very much.
Pleasure.
That was another episode of the Success Times Happiness podcast. Next time you're arguing about inflation rates, turn to the person next to you and tell them all about the show. It really means a lot. A huge thank you to Chris for breaking down a very complex budget with real-world insight and humour. If today's conversation challenged your thinking or helped you better understand what's happening in the economy, please subscribe, leave a comment, share it with someone who needs to hear it. It really means it. Until next time, peace.